Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, we've got the IPO market that's hotting up, and Popular Vehicles, the 600 crore IPO subscription opens today with a fresh issue of around 250 crores and OFS of around 350 crores. The IPO will close on March 14th. We have with us both the gentlemen, Mr. John Verghese, the Group CFO, and Mr. Naveen Philip, the Managing Director of the company. Hi, gentlemen. Welcome to the studio, and thanks so much for joining in.
Thanks
Before we get to the modalities of the business, the most obvious question is some part of this money is going to be raised for the company. So, and I believe some part of that will be used to deleverage the books as well. So what's the total debt? Break up the debt for us in terms of short and long-term debt. And how much of easing out of debt do you have post this issue?
Sure. Yeah.
So as of September, we carry nearly about 750 crores of debt in our books. 75% of it pertains to working capital.
Okay.
So about 100 crores was for the long term, which will get completely wiped off once with this fresh offer of 250 crores.
Got it.
So to answer your first question, out of 250 crores, about 192 crores will go off to pay off this debt, of which 100 crores will be for the long term, and the balance will be for the reducing the short term.
So what typically is the interest cost that you incur, and how much goes off? How much flows through into the bottom line?
Yeah. So average about, we incur about 9% interest cost. So on 250 crores,
about 18 to
comes
20
about 20,
crores.
18 to 20 crores
interest cost
will get reduced from the bottom line.
Okay. All right. Let's understand business then. I'm just looking at the client concentration or even the geographic concentration. It appears to be skewed. Do you have plans to diversify on that front? And if yes, how do we see this mix panning out?
Yeah. So the first thing is that our entire business is focused on service. We do sell vehicles, that's the primary part, but in terms of servicing of vehicles. So we serviced about 1 million vehicles last year.
Okay.
So 950,000 odd vehicles, and this year first half we've already crossed about 5.2 lakh vehicles. Now for servicing of vehicles, the car park should be strong enough.
Yeah.
And the company that provides the largest car park on the passenger vehicle side is Maruti Udyog.
Got it.
So obviously in terms of depth, we would like to go deeper with Maruti Udyog, and in terms of geographical expansion, also with MSIL in terms of that. If you look at the commercial vehicle space, again the truck park is skewed towards Tata Motors, and we are with the largest player of Tata Motors. So we service about 150,000 commercial vehicles also. So both these would be strong pillars as such. In terms of geography, if you look at, we were in South, Kerala, Tamil Nadu, Karnataka, we've expanded it to Maharashtra. These are states with a very large concentration of vehicles.
Got it.
The other states would be Gujarat, NCR region, Andhra, Telangana, and those would be the obvious choices where we would be expanding next.
So short point that you're telling us is you don't see it as a big risk, because you have planned this out in terms of sticking with the largest passenger vehicle player, largest commercial vehicle player, and the geographic dynamics as well. You're pretty comfortable with that.
Absolutely.
So on your services business itself, I wanted to say, because you said that you're primarily a services company which also sells cars. I was looking at your revenues. Sale of services accounts for just about 16%. Sale of spare parts and accessories account for just around 14%.
Yeah.
You said you are diversifying to Maharashtra. That was just in fiscal 2023 itself. Yeah. So let's ask you, from services and sale of spares and accessories, what would be your revenue contribution as you scale up? Yep. And Maharashtra, you entered in FY23, right? What would be the revenue from Maharashtra as you scale your business up as well?
Okay. So exact figures John can probably help you with, but I just want to give you a timeline of. So when you talk about turnover, and 15% of the turnover comes from services business. So service consists of labor and spares. Okay, labor is a low ticket value per se, but a high margin. So though only 15% of our turnover comes from services, 55% of our EBITDA comes from services.
Got it.
And spare parts will contribute another 7%. So about 62%. When you go down to the profit after tax, I think it will be closer to 80%.
Yes.
Would be from services.
Got it.
Now turnover gets skewed because when I sell, or when the Popular sells a Jaguar Land Rover car, for example, that's 1 crore ticket size. Okay, the services would be far smaller, bigger. So turnover will always be skewed towards sales, but profitability, EBITDA margins would be skewed towards sales.
So
If I may add to what Naveen said, to give you a flavor of the past 3 years, pre-COVID, post-COVID, FY19 versus FY23. The group turnover has grown by about 8%.
Got it.
CAGR. In this, the revenue portion has grown by 15%.
Okay.
Similarly, when you go to the EBITDA, at the group level, we have grown by a CAGR of 13%, but the service pie alone has grown up by 25%. Giving you an idea as to why we are saying that service is important. Most importantly, the profitability of service also has improved. Whilst in FY21, the EBITDA percentage margin for service was around 13%. In FY23, it is about 19%.
Oh, okay.
So again, to get back to what you said, that last year we did about 15% of our turnover was from service. 3 years back, it was only 11%.
So going forward,
Exactly.
What will the ideal mix look like?
In terms of service mix, so in terms of turnover, over the next 3 to 4 years, we'll expand at the same rate as what we've expanded in the past.
Got it.
I can't give you a futuristic projection on
Not
that.
now, but on listing, we'll get it for you.
From listing, we'll get it.
But again, to give you another flavor on that particular aspect, again, the same 3 years pre-COVID, I mean, not, say, last 2 years, FY21 to 23, organically, we put in about 50 service centers.
got it.
Inorganically, we put in another 20 service centers. So out of 134 service centers you're seeing, 70 has come last 3 years, giving you a flavor of your question. Which
So assuming that, all this goes on, say in the next 3 years, we can expect around 25% revenue coming in from services and a much higher contribution coming in because the margins have improved as well. That would be reasonable, right? On your business itself, your model as compared to another listed player's model says that you hold a lot of inventory on your books. What are you doing to de-inventorize, so to say, largely because that also is the reason why your working capital is high?
So firstly, the figure which you see at the inventory figure that you see is on a particular date.
Okay.
So it again is a factor of what the sales will take place in the next couple of months. So normally during a festive season, obviously we'll hold more inventory to ensure that the customers are satisfied. So if you look at it for the period, if you kind of correlate the interest cost versus the inventory which I held at the end of the period, there will be a miscorrelation because the inventory, that's not the amount of inventory they carry day on day. Okay. So it's just a reflection of the vehicle sales that's going to happen in the future.
Okay.
Just to add to that, it's like last year we did a turnover approximately 5,000 crores. We held an average inventory of about 400 crores, so 12 turns in a year, which is about 25 to 30 days inventory. And that over the years, it always remains around the same thing.
Okay. All right, gentlemen, we appreciate you all coming down to the studio and giving us a brief gist about the listing. We wish you all well. On listing, we re-invite you all on the show.
Sure.
And in fact, we focus more on numbers. But for the time being, congratulations on coming to the
Thank
stock
you, Nigel.
market.
Thank you, Mangalam.
Thank you.